Okay, good evening. Tonight is Tuesday, March 12th, and we just did quiz 3. And tonight I'm going to do chapter 17. It's going to be our favorite chapter because, one, for you, it's probably the easiest chapter in the course. And two, for me, dividends are the sweetest thing because that's how a business owner gets paid. Oh, in terms of an announcement, I said none, but I just had a... if anybody hasn't picked up their midterm or their group assignments, I have them here. I had one other thing. Oh, if you're still interested in the books, I got them for $10, no tax, and that's it. Any questions at all? Okay, so let's. Tonight should be a pretty early evening, I think. So in chapter 17, I talk about dividend policy. So we're going to talk about the beginning of the chapter is a little bit of qualitative knowledge, but then as I get in, there's a little bit of math, but really not that much. And then I'm going to show you the mechanism of how a stock split actually works, which is something you've probably heard of before. So if you look at the cash flow that a company the cash flow in and out of a company, you can look at it from the point of view of two things. One is internal cash flow. That would be, one, operating cash flow. So, buy something for 5, sell it for 10. Pay your employees, pay your rent, that kind of stuff. But also, it would be, say you have used equipment that you sell. That's not operating cash flow, but it would be considered internal cash flow. If there are changes in your net working capital, that would also be considered internal cash flow. The other place where cash comes from for a company is new financing. So that would be the difference in long-term debt from one period to the next, and also the difference between your shares, your common stock, between one period to the next. So if you sell, say, $10,000 worth of shares to investors, they receive the shares, but you receive the cash, and so that's cash coming in for the company. From that cash flow, you can do a bunch of things. The first one is you can invest. So mergers and acquisition, that's a pretty popular way of growing a company when, especially bigger companies, once they can't really grow organically, so what they do is they go and they buy other smaller companies that are doing better, and then they roll them up into their operations. You can reinvest into existing operations. That would be how you create organic growth, right? You make profit. If you've heard that expression from business owners before, right? We just took the money that we made and we just reinvested it in the business. Well, that's what's happening, existing operations. So it could be, I own a print shop, so I go and I buy a printer that prints on, vinyl, large format, or I buy myself some other new piece of equipment that allows me to acquire new customers, or maybe I just buy a new piece of equipment that lowers my operating costs. So staying with the print shop, say printers like from 5 years ago would cost you maybe 10 or 12 cents of color ink to make one page. And then the new printer now is only going to cost you like 3 or 4 cents. That's a way to reinvest your cash flow into existing operations. And then with the cash that's left, it says to shareholders. It's I don't see where they put the cash flow to debt holders in there. That's a little missing. But anyway, in terms of the cash that's going to shareholders, you can do it in 2 different ways. Either you can buy stock. That's if you're even if you're a private. If you buy shares from investors that have them and you pay them cash for it, that reduces the amount of shares of outstanding shares that your company has, and therefore that increases the value of each share. The other way is to pay cash dividend. there are some reasons, especially in the U.S. in the past, where the tax rate on dividend income was different than the tax rate on capital gains. Because when a company buys back their stock, then they reduce the amount of shares that are out there. That increases the value of one share. And so that's a way to flow. Repurchasing stock is a way to flow capital gains to stock investors. Cash dividends is a way to flow dividend income to stock investors. Especially in the U.S., you'll hear a lot more companies are buying back stock instead of issuing dividends or growing or having a higher dividend. It's because in the past, especially in the U.S., there was a big tax advantage to capital gains versus dividend income. So companies would never pay dividends because investors would say, well, if you pay me a dividend, I got to pay tax. And so that's why stock repurchases have been a lot more common in the U.S. market. In Canada, it's the tax on both is about the same, and so it really doesn't make that much of a difference. In terms of cash dividends, a few types can happen. The one that you're most familiar with is the regular cash dividend. So it's usually, it says usually each quarter. It could be each month, but it's usually paid each quarter. An extra cash dividend is also called a special dividend. That happens sometimes when maybe one company has piled up too much cash and all of a sudden they won't say, we'll increase our dividend. And because once you increase your dividend, it's not a legal requirement. It's not like a bond where investors can take you to court and put you in bankruptcy if you're not paying your interest payments. With shares, with dividends, if a company doesn't pay their dividend payment, investors you can't take them to court to force them to pay the dividend, except that if a company decides to lower their dividend or stop their dividend, what shareholders can do is instead of taking you to court to force you to pay, what they do is they sell their shares. So that's a way for them to vote and to protest that. And if you ever seen a company that suspends their dividend or drops their dividend, the stock just goes right through the floor. It's a really bad sign. We'll talk about that a little bit later. And so companies sometimes when they have a surplus of cash, but they're not sure that they can raise the dividend and maintain it forever, then what they'll do is an extra cash dividend, or like I said, it's usually called a special dividend. So it's like a one-time thing that would happen. Another reason why that would happen is, say a company divests itself of part of its operation, and they make money, say, selling, I'm a car company, and I sell my, say, truck business to somebody else. I make a pile of money with that. Well, that's not money that's going to re-happen every single quarter, every single year, and so you just declare a special dividend for that one-time profit. Liquidating dividend is actually fairly rare because that's if a company closes down. And remember that the bondholders have a priority claim on the assets of a company. So the only way that a liquidating dividend happens is if a company goes out of business and it has more assets than it has debt. Because if a company goes out of business, say, and it has $1 million in debt, but only $500,000 in equipment that they can sell used to pay back their bondholders, then there's nothing left for the shareholders. But if after when a company decides to close down, if after all the debt holders have been paid out, there's still money left, then it gets split between the shareholders per percentage of the shares that they have. But that's actually pretty rare. Now, it says the last point is not so important for finance people, a little more important to understand for accounting people. Cash dividends reduce cash, that's obvious, and retain earnings, except for liquidating dividends, which reduce paid-in capital. Cash are paid out of retained earnings. When you make money, you'll see that a little bit later today, when you make money, when a business makes money, it can do two things. It can keep that money in the business, maybe to buy stuff or reinvest in the company, or you can pay it out. And so that's where the expression retained earnings comes from. You make money and you're keeping it. Now, if out of that money that you're keeping is where the dividends are paid out. And so if I have, say, $100,000 in retained earnings, and I pay out $10,000 in dividends that year, that will reduce my retained earnings down to $90,000. Just a simple example here about dividends per share. So you had a company with 31,000 shares of stock outstanding and a market price of 15. The net income is 155 and the retention ratio is 70. Okay, I remember now why I picked this example. It's because I want to teach by example. There's two expressions in dividend policy: retention ratio and payout ratio. So let me just write it down. What retention ratio and payout ratio says, and payout ratio is a lot more common expression. You'll hear that when you listen to CFOs that go on financial news channel. What payout ratio is the percentage of your income that you pay out in dividends. So for example, Canadian banks will have a policy that says, our dividend is fixed at a certain amount, but our target payout ratio is, say, 30% of earnings or 50% of earnings. So what happens is when their business grows enough to the point that they're now making more money than before, and their payout ratio is then lower, then what they'll do is they'll increase their dividend to stay at a fixed payout ratio. That's how Canadian banks tend to make dividend policy decisions. The opposite is retention ratio, which is the percentage of your income that you keep in, that you put in retained earnings instead of paying out in dividends. And obviously, one plus the other is equal to 100%. So the dividend per share is going to be the dividends divided by how many shares you have. And the dividend is going to be net income times the payout ratio and the payout ratio is 1 minus the retention ratio. And so if your net income is 155,000 and you keep 70% of that, if you keep 70% of your income, then you're going to pay out 30% of 155. That's going to be the dividends in total that you pay to all your shareholders. And so you divide by the number of shares to get to what the dividend per share is going to be. But just the concept that's important to understand here is the payout ratio and the retention ratio. So next, let's talk about what's the actual mechanism, how this happens. So there's 4 dates, 4 events that you have to know in a mechanism for how a dividend happens. First, the board of directors, which is the board of directors is what has the authority to declare dividends on shares. It's not the CEO, it's not the CFO, it's not whoever, it's by a vote of the board of directors. When the board of directors declares a dividend, then they're going to say, we will pay a dividend on Monday, February 16 to shareholders of record on Friday, January 30th. So you have those 4 dates. The first one is when the announcement is made. Then, let me just skip the ex-dividend date in a sec. The record date is, you got to know where to send that money. Because remember, if you're a publicly traded company, almost every day and pretty much every day, whoever is a shareholder of your company changes. Right? There's every day your whatever the daily volume is on the stock exchange, those shareholders, change around. So when you say I'm paying a dividend, you have to figure out, well, who gets the money? And so the money is going to be paid at the payment date. It used to be, they would mail checks or whatever. Now it's done electronically. But the 2 important dates to understand is the record date and the ex-dividend date. And it works this way. When the board announces a record date, what they're saying is, on that day, we're going to look at who was a shareholder 2 business days ago. Because the way that the shares work, the way that they're traded, is say you buy or sell a share at 3:45 p.m. Market closes at 4. Well, the time for information to what's called back office and settlement in Canada, it's 2 days. So whatever whatever trades get entered into the stock market, basically all the paperwork and all the clearing of funds between the different brokers and all that takes 2 days. So if you're a company and you want to know, who do I send the payment to, what you do is, on the record date, you look at who was a shareholder at the close of business 2 business days ago. Because by that time, all the paperwork, all the clearing is going to be done. Now you can't really say at 4 o'clock, tell me who my shareholders are, because there's a trade that just finished at 3:58, hasn't cleared through the computer, there's paperwork, the brokers and the banks haven't exchanged the money. So what they do is they wait until the dust has settled, all the paperwork has been done, and then 2 business days later, not 2 calendar days, but 2 business days later, they look at, well, by that time the paperwork's all in, who was a shareholder as of 4 o'clock on the ex-dividend date. And it's called the ex-dividend date because if you own the shares at that point, you receive the dividend. If you don't, you don't receive the payment. So on the next day, after the ex-dividend date, if you buy the shares, you're not going to receive that dividend. Right? If I'm somebody that owns that just say buys the share on Wednesday during the day, then at the end of the day, the records are going to show that I had the share, and so I'm going to receive the dividend. But if I buy it, say, on Thursday at 9:31 a.m., then I'm not going to receive the dividend payment. So we say that the share has gone ex-dividend. In other words, you own it before that day, you receive the dividend. You own it you buy it after that date, you don't. And that's why X from not being there. And the payment date, it's really whenever the money is going to be sent. So I just explained it to you. Here's the text of it. Ex-dividend date occurs 2 business days before the date of record, and blah, blah, blah. If you buy the stock on or after this date, you do not receive the dividend. So it looks like this. The stock price falls by the amount of the dividend on the X date. So here's an example. On January 2nd, The board of directors of DDT declared a dividend of 75 cents per share payable on Monday, January 28 to shareholders of record on Monday, January 14. Under TSX rules, that's Toronto Stock Exchange, if you bought 500 shares of DDT stock on January 4th for $7.50, how much will you receive in dividends? So, if the they call it declaration date. So in this example, they will pay on January 28th. Shareholders of record on Monday, January 14. And they declare on January 2nd. And so if the record date is Monday, January 14, then the ex-dividend date is going to be Friday, so 13, 12, 11. So Friday would be the 11th, and Thursday would be the 10th. So since this person bought them on January 4th, right around here, they're before the ex-dividend date, and so they will receive, the dividend that they receive is how many shares they have times the dividend per share, and 500 shares is what they got. And the dividend per share is 75 cents. So they receive $3.75. What happens is, if they had bought it on Friday or after that, then they wouldn't receive that payment. So the next example, I think the dates are all the same. Monday, January 20th, shareholders of record on Monday, January 14. If you bought 500 shares of stock on Friday, January 11th, if instead you bought them here, then you receive zero because you bought it after the ex-dividend date. Now, the next part is, does the dividend policy actually matter? Because there's some, you can look at it and think, well, when a company pays out a dividend, then I get that cash. But if a company keeps instead of paying out the dividend, they keep the cash in the business and they use it to grow the business, then my share is worth more. So when it says, does dividend policy matter, remember that the value of anything in finance, any piece of paper, a bond, a piece of real estate, a stock, whatever, is the present value of the expected future cash flows. And so dividend policy might not matter, because if instead of receiving the fund, the company puts the money back in and they increase the value of the share by exactly that amount, then it really doesn't matter if they paid you the dividend or not. Your investment has the same kind of return. Let me show you an example here. In the first case, the net present value is going to be the cash flow in year 1 plus the cash flow in year 2 discounted back to present value. So the cash flow in year 1 is 10,000. Discount that back at 12%. And the cash flow in year 2 is also 10,000. And so that stock is worth 16,900. So if you have dividends of 10,000 per year for each of the next 2 years, or 9,000 in the first year, if you receive 9,000 in the first year, and then the company keeps the extra 1,000, they reinvest it in the business, and that means that they grow the business, and then in the second year, they're able to pay 11,120 instead. Both those two streams of cash flow are worth the same thing. So the way that you can look at this is if a company is able to reinvest the money back into its operations and get a better return than what the required return on the stock is, then that makes sense. But if the company is reinvest in the business and they're able to get a return which is exactly the same as the discount rate that the market's applying to their stock, then it really makes no difference whether they pay it or not. That's what irrelevance means. It doesn't matter. Okay, the next topic is homemade dividends. So similar to how I showed you in chapter 16, when an investor didn't like what the debt profile of a company was, then what you could do is, if you want to have create a synthetic portfolio from the point of view of the investor, that's why it's called homemade dividends or homemade leverage. What you do is you do something to counteract. So if you want, remember in chapter 16, if you want an investment with more debt, then what you do is you take personal debt to buy the shares, and that will increase from your point of view. And if you want an investment with less debt, then you sell some of the shares and you invest in the bonds of the company or similar bonds at the same interest rate and similar risk. And then what you do is you counteract the debt there. You can do something similar with dividends. If you own a company and the company pays you a dividend, but you just want capital gains, then what you do is you just take the dividend that the company pays you and you just buy some of their shares with it. That's called a dividend reinvestment plan. And it's been very successful investment strategy for lots of people for a very long time. Whenever a company pays a dividend, instead of taking that cash, you just put it back in. And so you end up creating, for your RSP plan or whatever, capital gains instead of dividends. If the opposite is the last one, if you have a company that never ever pays a dividend, up until not too long ago, Apple was a great example of that. Now they're paying a dividend, but it's peanuts, almost doesn't count. But say you have a company that you would like you like the business, you want to invest in it, but you want to receive some income every year, but the company doesn't pay dividend, what you do is you just sell some of the shares every year. And so say if the share goes up by 10% on average every year, that'd be a nice market if it did, but say you typically have a company that goes up by about 10% a year, but you would like to have a 10% dividend paid to you every year and have the same amount invested instead of the value of your investment going up. Then what you would do is you would just sell 10% of the shares that you have every year, but then the value of the shares that you have left go up by 10%, and so your amount invested stays the same, but you're receiving current income. So that's a way. The reason why it says the dividend policy would be irrelevant is just like with leverage. If you have an investor that still wants to invest in that company, but they don't like how the company is paying its dividends or not, then you can do, reinvest the dividend to create a capital gain and pay out, sell some shares to create a homemade dividend. So let me show you an example. You have Priscilla owns 500 shares of Delta stock. The company will will pay a $1 per share dividend this year and a 50-cent per share dividend next year. Priscilla does not want to receive the dividend this year, but she wants to receive as much dividend income next year. So the required return is 12%. Ignoring taxes, what will Priscilla homemade dividend per share be next year? So what she's going to do, you're going to invest or reinvest this year's dividend in the stock at 12%. And what's going to happen is this. So the homemade dividend in year 1, which is next year, so the current year is 0. It's going to be the dividend this year that she would have received, but she just puts back in the stock. And so that will go up by the return on the stock. And next year she will also receive the dividend at the same time. So the dollar from this year reinvested in the stock at 12% is going to be worth $1.12 next year. And then the 50 cents that she gets next year. So that would be $1.62. The only challenge with, in theory it works. The only challenge is that with, say, a company, you receive $1 dividend and you only own, say, 100 shares of stock. Well, it's if the share is selling for more than $5, it's hard to do this homemade dividend thing unless you have a certain amount. If you're a really small retail investor, the numbers don't, they're too, you can't split like a share into two. So say if I want to invest 10 cents, but the shares are trading at $20, well, it's not really doable. It's only doable if you have, in practice, it's only doable if you have enough of, if you own enough shares. But in theory, it works pretty well. So we talked about dividend policy, and so a company can decide, yes, I'm going to pay dividends, or no, I'm not going to pay dividends. So when a company doesn't pay dividends or they don't pay a lot, it's called a low payout. So why might a low payout be desirable? Well, if you have your investors are in high tax brackets, they will prefer to have lower dividend payouts because dividends are taxed when the investor receives them. And they have to pay tax now. But if an investor has the money in your stock and they don't sell the stock goes up every year, but you don't have to pay the income tax, the personal income tax on that stock going up until when you sell it, maybe many years later. And so that's a reason why investors might prefer a low payout, because they don't want to get dinged the tax on the dividends each year. They'll just wait. They basically leave the money to roll inside the investment, and then they pay the tax just at the end. Another reason, flotation costs. If you have a company that is expecting to need more money for investments, it could be, oh, we're going to build a new plant. It could be, we're going to buy another company. Then you don't want to pay out a dividend and then have to raise new money either by new bonds or new shares. Because remember, from chapter 14, you have the flotation costs. If I want to raise $1 million worth of new equity, that's going to cost me maybe $50,000, $100,000 in legal fees and investment banking fees and all that kind of stuff. And so it doesn't make sense for a company to pay out dividends to investors and then after that have to go back to the market and pay all the flotation costs to raise new capital that's going to be needed for expansion. And so that's why early stage companies tend to not pay dividends, or if they do, a very low amount, because they're thinking, if we need capital for something, we're better to keep it in instead of paying it out and then have to pay some flotation fees to go and get more investment. Another reason why you might have low payout, dividend restrictions in debt contracts, what are called covenants. Does it say there? They don't use the expression covenants, but that's what they're called. You might have, you might go and take a bank loan, say, for a bunch of equipment, or you might have, you might issue, say, a new series of bonds into the market, and those will have conditions in the loan or the bond that the company is not allowed to pay dividends until the bonds are paid out. Just one thing that a way that a debt holder could be screwed by a company is if you give them money for the bond, and then the company just pays dividend, and then there's not enough assets and not enough money, not enough cash left in the company to pay out the bonds, then there's that's the way that the debt holders would lose some of their investment. So there are conditions in bonds and bank financing that says you're not allowed to pay dividends past a certain amount. Maybe it's based on payout ratio, or maybe it's based on you gotta have a certain amount of cash in the company at all times. But that's a reason why a company might not be able to, not by choice, but by legal requirement, not be able to pay dividends and have, in other words, have a low payout. What are alternatives to paying a dividend? You can, remember, when you do your capital budgeting, you have a whole bunch of potential things that you could do. So you pick all the ones that have positive net present value. And then when you hit zero, well, there's nothing that you shouldn't go and do additional ones. But say that you only have enough money to do a few of the capital budgeting projects that you have. You still have some that you looked at that have positive net present value. And so that's, instead of paying a dividend, what you could do is invest into those capital projects until you run out of investments with positive net present value. Another alternative to flowing cash to shareholders in the form of dividends is to flow it to them by buying back shares in the market. I explained to you earlier how that worked. Acquire other companies. That's similar to select additional capital budgeting projects. It basically means that instead of paying out the cash to shareholders, you use money to invest in business. Now, it could be organically by doing investments in the company, or it could be externally by going in, buying another company and bolting it into your operation. And what you can do is, if you are not paying dividends, that what you have, and you have cash left over, you could put it into short-term marketable securities. And there's a funny story here about Apple. In the last time that the U.S. had their debt ceiling debate, where at some point they had reached their debt limit, and the Treasury Secretary wasn't allowed to issue new bonds from that point. And therefore, the cash that the U.S. had on their balance sheet was declining. It actually came to a point where Apple had more cash in their bank accounts than the U.S. government did. So it came down to Apple at that time had around $90 billion in cash, and the U.S. government, their cash balance was going down every day, and it hit like 50 or 60. So there was a time when Apple was a better financial asset than the U.S. government. So at the opposite, why would a high payout, why would a company put a lot of their income out into dividends? Desire for current income, especially individuals in low tax bracket. Here's a good example. For a private company in Canada, if a shareholder has no other income, they can receive up to the way that the dividend tax credit and the gross up. Anyway, the tax rules are pretty complicated, but just remember that number, $30,000. You can receive $30,000 in dividend income and not pay any taxes at all. So the first $30,000, as long as you don't have say you have a salary of $50,000, you can't just receive $30,000 in dividend income. But that's pretty common. So the example is me and my wife. I got a business. I can basically take out $30,000 out of it each year, tax-free, because I just put it to her. And it's a tax planning strategy called income splitting. And there used to be, what business owner would do is they would split, $30,000 to their wife and $30,000 to each child that they have. So like the 12-year-old and the 10-year-old and the 8-year-old. And instead of paying, because remember we have a progressive tax system, so if one person makes a lot of money and they pay all the tax, they'll pay it at a higher percentage. So when you spread it across different people, it's called income splitting. And business owners have gotten pretty good at doing that. A couple of years ago, the federal government came up with a rule that you can only do this for children that are 18 years or older. So you can still income split, but only to kids that are above 18. If you have kids that are below 18, so 17 and below, then whatever income you put on them is seen as income of the parents. So they, by changing that part of the tax law, and it's the nickname that has is the kiddie tax. That basically got rid of the tax advantage of income splitting to your entire family, all the kids. So now you can only split to your wife or anybody you want, but they have to be over 18. Another reason why you would want a high payout is uncertainty resolution. And the best example of that is Research in Motion, the BlackBerry people. For a long time, that was an example of a company. No, we're not paying any dividends at all, zero. We're just going to keep growing your business. Then their stock went up to almost, I don't know what the top was, but around $100. And then, they didn't come up with good new products for a long time, and then their stock, I don't know, it's around 10 or 15 now. So imagine if you're somebody that invested in that company back when it was 30 or 40, and you're like, I'm just going to leave that money in, and I'm just going to reinvest it, and it kept just going up and up and up for years and years and years, and now you're around 100. Wow, I bought the stock at 30, it's now worth 100. That's great. What happens when, boom, the stock goes down, say it's down to 15, all of a sudden, oh, I lost half my money. What uncertainty resolution means in here is if the company would have paid the dividend every single year, at least you would have received that money as a return on your investment. If a company goes, from 10 to 100 and then down to 0, and you started at 10, well, you lost all your money. But if each year, say they paid you $1 or $2 or $3 in dividends, at least you received that money. So uncertainty resolution means that by paying you the dividend today, you're sure that you got that money. It reduces the uncertainty of what your return is going to be in the future. Yeah, you might make $100, but you might lose the whole thing at the same time. But if you receive a dividend, you know at least that for sure you got that money each year. That's what they mean by uncertainty resolution. And it's probably the same thing's going to happen with Facebook. They're not paying a dividend. Oh, they're going to grow, to be the giant company. Maybe they will, maybe they don't. But if they don't, then at least if you have a company that paid a dividend, at least you got that money. And what dividends do is they tend to create a cushion under a stock price. A company that pays a good dividend when the market goes down won't fall as much as a company that doesn't. Because you know that, no matter kind of how bad things are, you're still receiving that return on your investment. And it creates a floor under a stock price. Reason for a high payout? Income tax. If a corporation pays a dividend to another corporation, which is called an inter-corporation dividend, you don't actually pay tax on this. It's a little bit more complicated than that, but I won't go into the details. You do pay tax, but it's refunded when you pay out the dividend out from the parent company. But just in general, when a corporation receives a dividend from another corporation, the tax is not 0, but it's almost nothing. I think it's 3% or 6% or something like that. The other thing is that if you're the type of investor that doesn't pay taxes, so there's 2 examples I can give you. Pension funds is one example. Another example would be, because the way a pension fund works is people pay into it, and then when they're retired, they receive a pension check, and so that becomes income, so they're paying tax on that. But the actual pension fund, the fund that manages the investment over time, they don't actually have to pay income tax every year on dividends and capital gains when they sell shares or if they receive dividends from company. Another example would be endowment funds, right? Because universities are nonprofit entities, then the money that they make through their endowments, they don't actually have to pay tax on. So when some investors will stay away from high payout stocks because they don't want to have to get dinged with the tax every year, tax-exempt investors like pension funds and endowments, they don't care because they're not paying it anyway. So that's a reason why pension funds and endowments would prefer to receive dividends. In other words, a high payout. So, dividends create a signal to investors. One challenge when you're an investor is that you don't have the same amount of knowledge about a business than somebody that's managing that business. So if you're an investor in Canadian Tire, you don't really have a good idea of how each store is doing. Right? But if you're the president of Canadian Tire, or if you're working in the accounting department of Canadian Tire, you have a pretty good idea of what's going on. Right? You're on the inside, the expression insiders. So the expression for this kind of disadvantage for external investors is asymmetric information. In other words, the managers of the company have a much better understanding of how well or how bad the company is doing versus somebody that's investing in a stock because they're not in the company. They don't see, they only see the annual reports and the quarterly statements. But the managers are there every day, so they have a much better understanding of what's going on. So when the managers of a company decide that they're going to raise the dividend or they're going to change the dividend, that actually sends quite a signal to the market about what's going on with the company. If you have a company that has a great history of paying dividends and they're really proud of that, and they don't want to raise their dividend and then later not have enough cash flow to pay it out, then whenever these managers do announce that they increase the dividend, that's a pretty good sign because it means that they're confident that the business is doing well enough that they're going to be able to pay that extra dividend into the future. Because the worst thing a company can do is pay a dividend, say, of $1, and then say we're raising it to $1.25 next year, and then at the end of year 2 say, oh, we didn't make enough money, we have to put it back to 1. That's actually worse than just having it kept at 1 the whole time. Because people that receive dividend income, usually retired people, they want to receive that check. They want to know how much money they're getting. So, if the management of a company is, playing with the dividend up and down like a yo-yo, then the investors are going to stay away from that stock. It says changes. If a company announces that they're either suspending, meaning we're not going to pay it for a while, or if they're stopping their dividend, that means that from the inside view, the company's doing so bad that they don't expect to be able to pay the dividend in this year or in the future. And that's a really bad sign, and then the stock goes back down. Well, just what I said. When you have a dividend increase, it's because the management believes that the higher dividend can be sustained. And that's a sign of a healthy, growing firm. And the opposite is if the dividend decreases or it stops, decreases to 0, then management believes it can't keep up with paying that. That means that the business is under financial stress. Now, the last qualitative point, and then we'll take a break, is what's called the clientele effect. Clientele meaning who are the people that are investing in your stock. Some investors, remember, will prefer low dividend payouts. So they will buy companies with low dividend payouts. Some other investors will prefer high dividend payouts. So they will buy companies that are paying more of their earnings out in dividend. So from the point of view of a company, the people that buy your stock will be the clientele, your investor clientele will be based on how you're paying your dividends, a high payout or a low payout. So you should, it really doesn't matter because, I just want to go to that point there and then I want to go back to the previous point. What happens when a firm changes its policy from a high payout to a low payout? Then what happens is the clientele, the types of investors that like the high dividend payout will sell the stock, and they will sell it to the investors that prefer a low payout. Therefore, it really doesn't matter what the dividend policy is, because when you have a high payout dividend policy, you track a certain number, but if you change what your dividend policy is, the people that invest in your stock will change, but you'll still have people investing in your stock. So that last point, you shouldn't really focus as a manager on what the dividend policy is that much, because instead you're much better at focusing on what you can do to increase the cash flow of the company, right? Do some net present value, positive net present value capital budgeting projects so that you increase the shareholder wealth of your company. And whether you pay a high dividend or not, that's a financial engineering thing. It really doesn't change what the core of the business is. So as a manager, you're much better to work on improving the core of the business than you are at playing at who's going to invest in your stock and what dividend you should do. So that was the last point that I was trying to say. before. If a firm changes its policy, it will just have different investors. So it really doesn't matter what the dividend policy is for the value of the stock. So here's a good place for a break. It's 7:55. Let's continue. So now we get into the slightly more mathematical part of the chapter. So first I'm going to talk to you about the residual dividend policy. Now that one works a lot better with private companies, especially middle market private companies, than it does for public companies, because remember that for public companies people expect to have the dividends stay the same or go up by a little bit. So with the residual dividend policy, the idea is that you invest all your retained earnings until you run out of things to invest in, and then you pay out the rest of it in dividends instead of just keeping it in retained earnings. So first you figure out what the capital budget for the company is, how much you need to invest in the next year. You determine the capital structure, so what is the mix of debt and equity that you want to use, and then you finance your investments, your capital budget, with a combination of debt and equity in line to keep the target capital structure. So a key point to understand in that retained earnings are equity. When you look at the balance sheet of a company, you have liabilities, blah, blah, current liabilities, long-term debt. Then you have equity, common shares, preferred shares, and retained earnings. So retained earnings are, in this case, are a form of equity. So when you say you want to keep a debt-to-equity ratio of 1, meaning that you want to have half the company financed with equity and half the company financed with debt, then if you want to invest new money, then what you would do is your retained earnings, that's the equity part of the new investment, and new debt that you go raise, either in the form of bank loans or selling new bonds, that's the debt part. And so that's how you're able to maintain a fixed capital structure, a fixed debt-to-equity ratio, is by using your retained earnings and then bringing in new debt to match it. After you do all this, if you do have money left, then you pay it out in dividends. So let me show you an example. Oh, well, that's just the picture. So if the new investments that you have to make are, say, up to $1,500, and you have, does it show is it based on this one? I'm not sure. But here's the idea. The more you have to invest in new projects, you use your dividends, and then if you run out of dividends, then you don't have of retained earnings, you don't have money to invest more. But what happens is once you've used all your retained earnings for a new investment, whatever is left is what you pay out. So if you had no money, no new capital investments to do, then you would pay out the whole thing in residual dividend. Remember, residual means the residue, meaning what's left over. So that's where this dividend policy, the name of this dividend policy comes from. So let me show you this example. So you want to invest $5 million in capital spending. So your investment's going to be $5 million. You want to maintain a capital structure of a debt-to-equity ratio of 2/3. So if you have a debt-to-equity ratio of 2/3, remember this little conversion formula. So 60%. Any new project, the capital structure of your company has to be 60% equity, 40% debt. Your net income is $4 million. And so out of this $5 million that you want to invest, you want 60% of it financed with equity. So you want to finance $3 million of it using equity. And you want to finance 40% of it using debt. And so what you do is you take this $4 million and you split it into $3 million goes into the new investment, and you have $1 million left, and that becomes your residual dividend. Then this $2 million would be new debt. So that's the residual dividend policy. First you figure out how much you need to invest, but in reality, in a quiz or final question, it's going to be given to you. But if you're got a real job and that's what you're doing, then you figure out all your positive net present value projects. So how much do I have to invest? Once you've decided on your capital expenditure budget for the next year, and you know what target capital structure you want to maintain, then you basically create this new investment using the same split that you had before. If you have a company, say, that's half debt and half equity, and then you make a new investment and it's also half debt and half equity, then therefore, after that new investment, you're still going to maintain that same target capital structure. That's the idea what's going on here is you maintain the same capital structure by any new investment that you have having the same split between debt and equity that your current company has. The equity comes from retained earnings. The debt comes from new debt. And then whatever is left would be paid out in residual dividends, meaning what is left over. So that's a residual dividend policy example. Here's another one. Now this one I'm going to do using the formula, just directly. So if you write it out, residual dividend is going to be equal to your net income minus the change in retained earnings. Right? Remember that when you invest that money into that new investment, that becomes retained earnings. You don't actually, that becomes retained earnings on your balance sheet. Say if I made $10,000 and then I use $3,000 of that as the equity into my next year investment, then that $3,000 is going to stay in my retained earnings account. So what I mean by change in retained earnings, my last example where I was using $3 million from retained earnings, then after doing this, the retained earnings line on the balance sheet would have gone up by $3 million. If I hadn't used the retained earnings for new investment, then it would have been paid out in dividends, and so it would not be in retained earnings. So if you look at what is a residual dividend, it's what your net income is minus what you need to put into retained earnings to invest in the new thing. And what you need to put there? Well, it's the weight of equity times the investment that you want to make. And remember that weight of equity can be written as 1 plus debt to equity ratio. So you can rewrite this as net income minus investment divided by 1 plus debt to equity ratio. So when you do a residual dividend problem, you can use one of two formulas. Either this one, if the target capital structure is given to you as a weight of equity, or this one if the target capital structure is given to you as a debt to equity ratio. So in this case, high-low wants to maintain a debt to equity ratio of 0.75. So I'll just plug in the numbers into this. Net income is 1,800. The investment is 2,000. And you want to maintain 0.75, so you divide by 1.75. And so after whatever that is, 2,000 divided by 1.75, that would be about $1,200, about $1,143 will be used to make the investment, and then what's left, the $657, is the residual, and that's what gets paid out in dividend. So that's a residual dividend policy. Two more types of policy are the cyclical dividend policy and the stable dividend policy. If you think not a lot of companies, but a fairly decent amount of industries have some pretty strong seasonal patterns. Two good examples are retail and construction. But construction, that's even more in Canada. If you talk about, say, construction in Florida or in Phoenix or places like that, you don't really have the same seasonality. But if you're talking about a construction company in Ottawa, if you're talking a construction company in Calgary, well, the ground is frozen solid like 4, 5, 6 months of the year. And the guys don't want to be, and the girls too, don't want to be out, in the out on the job site, when it's minus 40 outside and they're getting pounded by wind and so on. So if you take construction, very strong seasonality in their earnings. So if you have what's called a cyclical dividend policy, what you do is you take whatever the amount of money you made in that quarter and you apply a payout ratio to it. And so if the earnings per share are going up and down per quarter, then each quarter you're going to be paying a different dividend. If instead what you can do is use what's called a stable dividend policy. So what you figure out is, remember that seasonality, once you look at it over a year, things tend to flatten out. For example, if you look at retail, it always has the same pattern, right? It goes up in November and December. It's not like one year it goes up and down in July and the other year it goes up and down in March and so on. So if you know that your business has quarterly seasonality like that, it's always going to be on the same kind of cycle. So what you do is you look at what am I going to make over a full year? And then I take that forecast and I spread it evenly over each quarter. So let me do an example of each, and then you'll get it. It's pretty simple. So if you take the cyclical dividend policy, and what we want to know is what is the dividend for the fourth quarter, then it really doesn't matter what happens in the other quarters. When you make a loss, you pay 0. And then when you make a profit, you pay a fixed percentage of what the profit was in that quarter. So in this case, the dividend in the fourth quarter would be the payout ratio times what the net income in that quarter was. Now, it says here that the retention ratio is 40%, and so the payout ratio is going to be 60%. If you keep 40%, then you give out 60. And in that quarter, you made 115. And so the cyclical dividend for fourth quarter is going to be 69,000. If instead what you have is you want to pay the same dividend each quarter. So you don't want to send, a shareholder, $1 a share the first quarter, 30 cents a share the second quarter, $1.25 the third quarter, and $3 the fourth quarter. What you want is to pay them the same amount each quarter. So what you do is you got to figure out how much money do I expect to make each quarter, sum it up for the year, and then even it out. So in this case, the net income for the year is going to be the sum of the net income for each quarter. So you're going to make $3 million over the whole year. So the dividend over the whole year is going to be the $3 million times the payout ratio. And that's $3 million, and the payout ratio is 40%. So over the whole year, you will pay $1.2 million in dividends. And so if you want to know what is the dividend for a given quarter, you just divide by 4. So the next one is what's called WIFL, W-I-F-L, and it stands for whatever I feel like, and that's actually how most private businesses do it. Bigger ones tend to do more the residual dividend policy. Public companies tend to do the stable dividend policy, and if you're a small business like mine, you just based on whatever. It could be that in a given year, I don't have that much expenses, so I'll keep more of the money in the company, or I have income from somewhere else, so I don't want to be in a higher tax bracket for that year. Or it could be that in a given year, I want to buy myself a boat, so I'll pay myself a big dividend that year. Or it could be that I want to maintain a certain debt-to-equity ratio, or I want to maintain a certain payout ratio. So typically, for me, I tend to think, 50-50. Half of the money that I make, I paid out in dividends, and the other half I leave in the business and, fix up the parking lot, buy some new chairs, whatever. The company wants to, one thing that you have to be, that's more for public companies or private companies that have arm's length investor, meaning they're not like your family or your friends or whatever. You really want to avoid dividend cuts because that's something that investors really, really hate. And a company that cuts their dividend, usually the investors can't sell their stock fast enough. And so you want to, whenever you decide, you compromise between these different goals. So the company wants to accept as many positive net present value projects as possible because remember, every time you invest into a project that has a positive net present value, the value of the equity in your company goes up by that amount. Now let's talk about a stock repurchase. How does that actually work? Remember that instead of dividends, a company can flow cash to shareholders in the form of a stock repurchase. So the company buys back its shares. A tender offer is where, just like a board of directors will give will pay a dividend of that much. What a board of directors can do is, the company is authorized to buy back 1 million shares at, a price not to exceed a certain amount. And so then investors kind of already know what's going on. It's similar to a cash dividends that it returns cash to the stockholders. I've already explained that. And that's an argument for dividend policy irrelevance and that's a key point there, in the absence of taxes. If you're in a jurisdiction where capital gains is taxed at a different rate than dividend income, then companies will just tend to do the one that has a lower tax rate. So let's look at an example of a stock repurchase. One thing you have to be careful here is it says there's a P/E ratio of 15, and then we're going to also use the debt to equity ratio. So you got to be careful to not mix the E and PE stands for earnings, but the E and D/E ratio stands for equity. So don't mix up those two. So first, what is the earnings per share after the stock repurchase? Well, to figure out that, we got to figure out, we have a fraction. We have earnings and we have shares. So we got to figure out how many shares do we have and what are the earnings. Well, what are the earnings is, if you have a P/E ratio of 15, you're able to figure out what the earnings are that way. Where did I put that? First, I'll figure out how many shares I have. So, what is the amount of equity that I have? Just use that trick of multiplying by a fraction. Right? If I take something and multiply by 1, which is d divided by d, that doesn't change the value of. If I just take any number and I multiply it by b over b, then it's still that same number. So then you can rewrite this as d divided by the debt to equity ratio. And we know that the debt is, we're doing the right example here. Oh, sorry, it was in the wrong, yeah, I get it now. I was in the wrong notes. That's why I was so confused. Okay, back to this one, sorry. So the net income is going to be the earnings per share that you had before times the number of shares. And the earnings per share that you had before would be the price of the shares divided by the price to earnings ratio. If you have 10,000 shares, if you have shares at $30 and the P/E ratio is 15, then you will have 15 times that in, 1/15 of that in earnings. So, still S from there. Sorry, if the price of the stock is 30 and the P/E ratio is 15, that means you will have $2 per share of earnings, and you have 10,000 shares. So the net income is $20,000. Now, if the company buys back $120,000 worth of stock, then the amount of shares that you will have afterwards is going to be 10,000 shares minus, you're going to buy $120,000 worth at $30, meaning what, 4,000. And so after you buy back the 120, you will have 6,000 shares. And so if I want to know what is my earnings per share now, and that's the key point to understand with a stock repurchase. You're not changing the amount of money that the company makes. You're just reducing the amount of shares that income gets spread across. So the earnings per share after, net income's not going to change. And so you'll still make the 20,000. But now you're making the 20,000, there's only 6,000 shares. And so the earnings per share goes up to $3.33. And therefore, because each share has a bigger claim of income, then it's going to be worth more. That's the way that companies flow their cash flow to shareholders in the form of a stock repurchase, because what they do is by reducing the amount of shares out there, the amount of money that each share that is left, each one of those leftover shares has more money for it, and therefore it's worth more. So that's kind of a roundabout way of sending money to shareholders. You don't actually mail them a check directly. You just buy back something, and therefore what they have is now worth more. Okay, so this is the makes a lot more sense now that the right examples on the slides. So when it says DE ratio of 0.5 but a PE ratio of 10, remember that the E there is not the same thing. In DE ratio, it's equity, but in PE ratio, it's earnings. And so I want to know how many shares of stock will be left after MDM completes a $25,000 share repurchase program. So first I want to know, well, how many shares do I have to begin with? So the equity, remember that little trick I showed you? One way to get to how much equity you have is to take how much debt you have and divide it by the debt to equity ratio. So if you have $50,000 in debt, and you have a 0.5 debt to equity ratio, that means that you have $100,000 in equity. And therefore, the amount of shares that you have, if you have $100,000 of equity, and they're each worth $25, that means that you have 4,000 shares outstanding. Now, if we want to know how much shares we're going to have afterwards, so we had 4,000 before, and they're going to buy back, where does it say? They're going to buy back $25,000 worth of shares, and they're selling at 25, meaning that they're going to buy back 1,000 shares, and so they'll be left with 3,000. Sorry about the confusion of two slides. It doesn't go very well when I try to give the one answer to the next one. So what are some of the real-world considerations? Stock repurchase allow the investors to decide if they want the current cash flow and the tax consequences. So remember, the difference between dividends is when you receive a dividend, you got to pay income tax each year. But when it comes to capital gains, you only pay it when you maybe, you made a paper profit, an unrealized capital gain, but up until the day that you actually go and you sell that investment and you receive the money for it, then at that point, over multiple years, that difference is the capital gain, and then you only pay tax at that point. So when a company does a stock repurchase, then an investor can just decide, instead of flowing their profit to the investors in terms of dividend income where they get dinged every year, the investors can just decide to just keep their shares. And because of the stock repurchase, the value goes up, and therefore they defer the income tax on that income. The next point, I won't put that on an exam. It's more of an accounting thing. It's if you're an accountant and you like income tax, you have a job for life, because there's buildings full of accounts. All they do all day long is just income tax stuff. Anyway, there's some special rules in Canada about these things called deemed dividends, but I won't put that on an exam. So what signal does a stock repurchase give to the market? It gives a positive sign that management believes the stock price is too low. Because if the company buys back their shares when their price is overvalued, what they're doing is they're overpaying and they're burning up the cash of the company, and it's not, it doesn't make sense. The opposite is, whenever there's a stock repurchase, what the signal that it sends to the market is the company believes that the stock price is low. Because it's an advantage of the company to reduce their amount of shares when their stock price is low, because the same amount of cash is going to cut down more of the outstanding shares. When the price is too high, and say I just put the same fixed amount of cash to buy back the shares, I'm going to end up buying back less. And therefore, when the price is is too high, it's better for the company not to buy back shares. When the price is too low, it's better for them to buy back shares. So when a company decides to buy back shares, it signals to the market that the management thinks that the current stock price is too low, because it only makes sense for them to do that if it was. We talked about cash dividends. There's a special thing called a stock dividend. And that's when, instead of saying, for every share that you have, we'll give you 10 cents, in the payment that you give is more stock of the company. So it could be that you'll say for every share that you have, we'll give you one new share. What that does is it doesn't change the total value of the equity of the company, but it just increases the amount of shares out there. At the same time, it reduces their number by half. This is what's called a stock split, so we'll get to that in a second. Stock dividends is the actual mechanism by which a stock split is done. So the example there, if you own 100 shares of a company and they declare a 10% stock dividend, that means you receive 10 shares. You don't receive cash, you just receive shares of the company. So here's an example here. Remember that dividends are paid out of the retained earnings account. And so it's the same thing. If you pay a stock dividend instead of paying a cash dividend, what you do is you reduce the retained earnings by the amount of shares that you're giving as a dividend to your investors at the current market price, not the historical cost that you have on your balance sheet. So if you have, let's say, a 5% stock dividend, yeah. So you have 6,500 shares. So a 5% stock dividend is going to be 325 shares. And so the retained earnings, let's say the balancer that you get, the retained earnings after are going to be the retained earnings before minus the change in shares, the shares that you're paying out, times the market price. So the retained earnings before was 142,900, and you pay out 325 shares out as in dividends, and they're worth 2650. And so after that transaction, your retained earnings account will be 287.50. Now what happens is your common shares account on your balance sheet will not change. But what's going to happen is those shares, remember that there's what you put on your balance sheet is the cash that you received when you sold those shares. So if a company went public 10 years ago at, say, $10, but today it's worth 50, and you have, say, 1 million shares outstanding, you're still going to see common shares on the balance sheet. It's still going to be 10 million. It's not going to be 50 million. And so when you do a stock dividend, the retained earnings goes down, but the actual common share line doesn't change because you didn't receive cash from the investors. So the reason why you need to understand how a stock dividend works is that's how a stock split is done. Why would you want to do a stock split? If you're, say, a company like Apple, and your shares are worth, well, I don't know, 600 nowadays, and it used to be even worse because as anybody, when you went to the stock exchange, you can only buy a block of 100 shares at a time. Like you can buy 100 or 200 or 300, but you can't buy 3 shares or 4 shares or 1 share or 17 shares. So what happens is, say I really like Apple, and I'm a retail investor. Well, if the stock exchange trades in 100 share blocks, the smallest investment that I can make is 60,000. Let's say I'm just putting money in my RSP or whatever, and I want to put in, say, 10,000, and I want to put maybe 10% or 5% of it in Apple stock. I can't do that because the smallest amount that I could put in is more than what a block of shares would do. So what a stock split does is it makes the shares more accessible to smaller investors by the total value of the company is still the same. If you do a 2-for-1 stock split, you double the number of shares, but each one of those shares is worth half. In reality, what happens with a stock split, and there's lots of insider trading scandals with lawyers in the 80s and stuff, is people would, when a stock split was happening, they would buy shares and they would make a little bit of money. Because what happens is, when you do a stock split, you increase the liquidity of the share in this way. Say I'm a big investment fund, a big mutual fund, and I want to invest exactly 5%. But if the share is, I can invest 60,000 or 120,000 or 180,000. What if I want to invest 75,000? Or what if I want to invest, 105,000? By doing a stock split, what you do is the equity that's out there is still the same, but you break it into smaller pieces. Because of the fact that now more people are able to access it, or instead of buying, say, 1 block, they'll be able to buy, instead of buying 100 shares, after you split them 2-for-1, they would be able to buy 50, 100, 150, or 200. that makes the share more liquid and then increases the value of it. So even though a 2-for-1 stock split, theoretically the shares should be worth exactly half after the split, what happens in practice is they're cut down by half, but then they go up a little bit because of that liquidity premium. And so stock splits are good when a share is way too high. The opposite, I don't know, is there a slide for reverse stock split? No. The opposite is a reverse stock split, and that's a really, if cutting the dividends is a bad thing, having to do a reverse stock split, you look like even more of an idiot. If you're a company and your shares go down below a certain price, most exchanges have a minimum price to be on that exchange. So I give you the example of Canada. We have basically kind of a farm league and then a major league stock market. You have the Toronto Stock Exchange, and then you have the Toronto Venture Exchange, which is what people call penny stocks. So a lot of exchanges like the Toronto Stock Exchange, the New York Stock Exchange, and those places, they don't want these little dinky companies, so they put in a rule that your stock price has to be at least $1 to trade on our exchange. And if it's below $1, you get delisted. Right? We don't want these speculative penny stocks on our high class type of market. So what some companies do that they're forced to do is, say if their stock price falls below the minimum price that they need to be on that exchange, what they do is they do a reverse stock split. And what happens with that is, say if I do a stock split and my stock is worth $10, then after that I'll have twice as many shares, but they'll each be worth $5. If instead, say I have a stock that's worth 50 cents, but I do a 4-for-1 reverse stock split, or I don't know if they call it a 1-for-4 reverse stock split, then what you're going to do is reduce the amount of shares that you have out there by 4, but up the price by 4. So instead of, say, having a million shares at 50 cents, or instead of, say, having 4 million shares at 50 cents, you'll have 1 million share at $2. Then the value of the company didn't quite change, but it's just a trick to keep the stock at a certain price. And that happened with some of the banks in the States that got, I think the one bank that did that was Citibank. Because their stock used to be at around $40, $50, and then they had a pretty tough time, and it went down to like 20, 30 cents. And so they did a reverse stock split to bring it back to a more reasonable range. And that's the reason to do a stock split, is to either when your price is too high, you do a stock split to put a good price for a stock. One that makes sense is like between 10 and 50. Once you have companies like Apple that are worth, 600 a share or whatever, or you have somebody that's been running a company like Warren Buffett that doesn't believe in these stock split, and one share of Berkshire Hathaway now is worth like $150,000 for just one share. That means that if you want to invest in Berkshire Hathaway, well, they did a second class of share with a more regular price, but if you want to invest in Berkshire Hathaway, and the block is 100 shares, that means that you got to put in 13 million is the smallest amount that you can invest in the stock. So stock splits make sense for that reason. Let me do an example. That'll be the last example of today. So you have a company that has the market value of the equity is 420,000, and the number of shares is 6,000, and so each share is worth $70. If you do a 2-for-1 stock split, then you will go up to 12,000 shares, but the total value of those shares is still going to be 420,000. And so now each one of those shares is going to be worth only 35. So that's it for today. I will see you next Tuesday. There's a summary, but it's basically a recap of what I said so far. And there's a couple of extra examples, but you can just try those on your own as practice to prepare for the quiz, which is not next week, but the week after. And you have all the solutions are all in the notes.